Welcome to Common Ground with Bill Walton, featuring conversations with leaders, entrepreneurs, artists, and thinkers. Fresh perspectives on money, culture, politics, and human flourishing. Interesting people, interesting things.
Hi, I'm joined today by Rachel Greszler and Adam Michel, who are both with the Heritage Foundation. Rachel researches and analyzes taxes, Social Security, disability insurance, and pensions to promote economic growth. Adam focuses on tax policy and the federal budget as a policy analyst at Heritage, and he focuses on the economics of taxation, international tax competition, and the federal budget. And we're here today to understand the recent bill that's come out of the House called the Tax Cuts and Jobs Act. And together, we are going to try to understand what it is, make it interesting, and have us all know what's at stake for ordinary Americans. So welcome, guys.
Sounds like quite the task.
Well, at least we'll make it fun. Yeah. So Adam, tell us about what this bill is about and what's in it. And
Yeah, well, thanks for having us on. The bill does a whole lot of things. The legislative text is over 400 pages long, and the House is attempting to correct many different problems in our tax code. As we know, it's incredibly complex. The current tax code it's a burden on individuals and businesses, and this legislation aims to address some of those problems. Most importantly, the legislation fixes our business tax environment, especially on the corporation side. So currently we have the highest corporate tax rate in the developed world at almost 40% when you add in
35%
state rates,
federal and average state
and
5%.
So it lowers that rate to 20%, which is what drives this package as being pro-growth. That's the piece that will get businesses to come back to the United States, add additional jobs, add to economic growth. And then paired with that, there's a whole bunch of changes on the individual side. The tax code consolidates tax brackets. We currently have 7. They move to 4. There's a doubling of the standard deduction, which simplifies tax paying for a lot of sort of average Americans. And then they make some changes to pass-through businesses, or what a lot of people think of as small businesses, that they try to provide a tax cut there, capping the rate at 25%, but add in some additional complicated rules that make that a less straightforward part of the tax reform. But overall, the tax package is definitely a step in the right direction. It's pro-growth, it's pro-worker, and so we'll sort of see how it evolves through the process. But right now, it's in the House of Representatives.
Rachel, what are the key pieces of the individual side?
So the big things there, Adam mentioned the doubling of the standard deduction. So you now have it that individuals won't be taxed on the first $12,000 of their earnings. This is assuming they don't itemize. And married couples, the first $24,000. So that kicks up. Then you also have the rates. The rates have come down. We used to have anywhere between 10 and 39.6%. They're now just 4 rates. It was 3, we hoped, but it went to 4. So you start with a 12% rate, 25% rate, and then a 35% rate, and then they did kind of last minute add back in the current 39.6% rate. So on the top, there's not really a rate cut, and we can talk about this later, but there's also a bubble rate that actually gets the top rate to 45.6%.
Where would we be without a bubble rate?
Back in '86. So the rates, particularly on the lower and middle income families, have come down, and they've also shifted the brackets a little bit. So a higher portion of your income is subject to that lower rate. But on the upper end, the 35% rate, the 39.6% rate, those have shifted up a little bit. Well, I guess just the 35% rate. And so you have the case that people making under about $250,000, they're going to see a tax cut. They're going to be subject to a lower marginal rate, but there's going to be a big chunk of income in there between about $200,000 to $500,000, where they're actually going to have a higher marginal rate than they previously did. So that's one of the downfalls that is on the individual side. Marginal rates matter so much because that's changing the incentive at the margin. Do I work more? Do I invest more? Do I grow my company, create more jobs? And that's all what the marginal rate has the biggest impact on. And so you haven't done a lot where most of the economic activity is occurring in the economy there.
Now, are there going to be more people that pay taxes because of this bill or fewer?
We were just discussing this. I think that you'll have a small decline in the percentage of Americans that are paying federal income taxes. That's probably largely going to come from the standard or the child tax credit, which was increased from $1,000 to $1,600. We had the doubling of the standard deduction, but that's coupled with also eliminating the personal exemption. Those two mostly wash each other out. It depends on how many are in your family. So it could actually be a tax increase for very big families, tax cut for lower ones. But then when you add in that child tax credit, it's $1,600 now instead of $1,000. You're probably pushing some more people off the tax rolls at the lower end.
And so, well, most people are paying payroll taxes and FICA, so on and so forth. Many people are not paying federal income tax, and what is that, like 45% of Americans are not in the tax system? And this
Yep,
brings it
that's about right.
to what?
We don't have a good
You're
estimate.
not
but
sure
I
yet.
don't
Well,
think it's
we're also
probably gonna
not
tip
fully
it over
baked yet. I
50,
mean, this is,
Exactly.
and it could increase over time, depending on some measures. Inflation parts could bring it back, but
but in my perfect tax world, we'd be broadening the tax base so more people have the stake in the system. I think one of the
Exactly.
flaws we have is that we're cutting taxes, but then for half of America, it doesn't really matter because they're not part of it.
And this is part of the sort of box that Republicans have put themselves in. One of the two big goals of tax reform that have been pushed is both the business reform, lowering the corporate tax rate to 20%, or what we had hoped would be 15%, but then also this idea that we have to provide significant tax cuts to the quote unquote middle class. And that's a great talking point, but actually doing that is more difficult than one would think it should be, just because of this. 50% of people already don't pay a lot of income tax, and then the fact that the top 10% of income earners pay 70% of the income tax. So anytime we're talking about reforming the system, the income tax system, we have to, at some degree, be talking about bringing down those top rates as well. And so moving around those pieces, trying to provide a big tax cut for folks that already don't pay a large share of the total income tax becomes hard as you move those pieces around. If you're
You
also
cut the rates,
trying
but if they're not paying
if
much
you're-
in, it doesn't matter.
Exactly. And
There's
if
no
you're
rep-
also
yeah.
trying not to, so if you're trying not to provide a big tax cut for the quote unquote rich, you sort of are out of options. You have taken things off the table that should still
you
be on the
didn't. You
table.
didn't say this. I said it. But it seems like we're still in the class warfare mode, where you've got to soak the rich if you're going to have a tax system.
And that's what's unfortunate about leaving in the top 39.6
Yeah.
bracket is even though the income brackets were moved up to 500,000 and $1 million if you're a married couple, the leaving in that bracket has real economic consequences. That the people that are most sensitive to those high marginal rates are the most wealthy, the people that can choose to retire or to work less, scale back how much they work, and it does have work incentives. It changes savings behavior and investment behavior at those top marginal rates, and that's what's to make this plan as pro-growth as it could be. We really should have attempted to address that top rate.
I don't know the tax history all that well, but wasn't part of the '86 tax bill where they dropped the highest marginal rate from something like 70% to 30%? Was that? Am I getting my tax
was it
history
30 or
correct?
was it even lower?
Yeah, I don't
There was some
remember the-
dramatic
It was like-
reduction.
yes, it was a huge
And so
jump.
what happened was, at that lower rate, they collected 3 or 4 times the tax revenue from the higher earners. I mean, so the history shows that if you drop the rate, you collect more revenue.
And a similar story happened in the 1920s, similar thing in the 1960s, and then in
Yeah.
the 80s, these big individual rate cuts were part of tax reform. And this time around, the focus was always on bringing down the corporate rate because that was the most detrimental part of the tax system. And we're moving in that direction, and that's fantastic. But it sort of has left behind this other piece that is also important.
Well, for those of us who thinks the individual side is pretty small ball and doesn't get at, I mean, Trump wants to call this cut, but it's more like cut. I mean, we've got one thing that's really cut here, which is on the corporate side. On the individual side, we can get into the details, but it doesn't seem like it accomplishes an enormous amount. On the corporate side, though, we're going from 35 to 20%, which is good, puts us more in line with the rest of the world. My goal was to get us to Ireland, which is 12%, but we didn't get there. And we also expense capital expenditures immediately for some classes of assets, and that's a good thing. That'll speed up capital investment. We also repatriate income from abroad. It was going to be a 5% tax rate, and I think now they've increased that today as we speak to a lot higher number.
To 14 and 7 for cash and physical assets. But all of these things are moving targets at this point. That'll continue. We haven't seen the Senate text, and it'll keep moving. These things
I'm sure
will
the
keep
Senate
moving,
will be
but
very constructive.
the
What are the? Why couldn't we have just done the corporate now and save the individual for later? I mean, why do we have to do it all at once?
So we've tried to do corporate only reform in the past. This was something that the Obama administration was favorable towards, and what makes it difficult is our system is through our system is I think it's 90% of businesses in America aren't those big C corporations. Although that's the rate that really matters. If that's the rate that is most detrimental currently, if you just do corporate only, there's this big portion of the business community that feels left out,
Which are individuals.
and pass-throughs. And
Let's explain what these are. I mean, for the big companies, they're in the C chapter of the corporate code. And for all the other businesses that are LLCs, partnerships, and S corps, they don't pay taxes at the business level. They pay taxes
As
as
individuals.
individuals, as the owners. And those are taxed at the now 39% rate. And so that's not enormously different from
plus
the
the
35%
3.8%
rate.
Obamacare tax.
Plus the 4 point, yeah. Okay, yeah.
Plus some phase outs. Add onto it.
The AMT, fees limitation.
But if you drop the 35% corporate rate to 20, then there's an enormous gap between the two. That's why it's got to be addressed.
Yeah, and you
That's
have
why
to,
you couldn't do it just the corporate.
Yeah, and I think also you talked about the class warfare before, and when you do something that's only on the corporate side, no matter how many economists agree that the corporate tax is the most detrimental, you are always going to have people saying you just want to give big businesses back money. And so I think that's why we're bringing in the individual side, and it's so much more popular when you're saying, oh, this is a middle class tax cut. Then I think they can swallow the business side and say, on net, this is a tax cut for the business community, for corporations, S corps, whatever you are. But they also had to tie into it the individuals so that they're getting something out of this tax reform bill, because I think a lot of people focus more on what am I going to get back next year in my tax bill, as opposed to how much higher is my income going to be in the long term because you've done this, economically advantageous corporate side reform.
Well, I think you mentioned most economists. I think the corporate tax has been said to be a real damaging impact on both workers, consumers, capital investment.
Yeah.
Some people argue that the corporate tax, if it went away, we'd see a dramatic wage increase.
Yeah, and that's it's really difficult to sell that piece of it to people. Is the corporate tax brings in around 9% of all federal revenue, but it's a double tax on the same income. So although those pass-throughs that you were just talking about are paying that 39% rate, the corporate side is paying a 35% rate, and then again a 20% tax on the individual side when that profit is distributed through capital gains or dividends. So there's a compounding sort of double tax on the corporate side that makes it even more destructive. And you're right, those pieces paired together and our corporate tax rate being the highest in the world means that businesses have been leaving the United States, not just their headquarters leaving. Burger King has moved to Canada. Anheuser-Busch has moved to Belgium. But
What people call inversions, where
tax
they
inversions.
get acquired by a foreign company.
That's sort of the sexy headlines. But what's going on underneath is they're actually moving physical capital abroad or not investing physical capital here, and that is why one of the reasons why wages haven't grown as fast as they should have. The most striking piece is, I think over the last 8 years or so, there's been a couple years where we've actually had negative capital growth per worker, which is horrible for wage growth, for people getting additional skills and working with better technology, which is the key piece of increasing output and economic growth. And so reforming our business tax environment can allow businesses to invest in America again, invest in American workers again, and that's how this translates to a larger economy, to higher wages, and that sort of knock-on effect is hard to sell to people.
So the formula, though, is you lower taxes, business have more capital to invest, they can put it in plant and equipment, things like that. And that's better for productivity, better for wages, and better for job growth.
Exactly. That's
We also have something that in the bill that tries to attract the capital that's been kept outside the United States. There's something like $2 or $3 trillion that people estimate is outside the United States, not being brought back by companies because they don't want to pay the higher rates in the U.S. What happens with this bill with that?
Yeah, so we currently have a worldwide tax system where the United States attempts to tax foreign profits that are made in other countries by U.S. headquartered firms. And basically no other developed country has this system, and it effectively locks corporate profits that are earned elsewhere out of the United States. So if I earn some profits in Ireland or in Canada, the United States levies a tax penalty if I ever want to bring that money back and reinvest it in the United States. So it has locked these several $1 trillion abroad. The system that is being proposed right now is called a territorial system, and going forward, it will not attempt to tax profits earned overseas, which levels the playing field for American businesses competing abroad. There's a transition measure for that trillions of dollars that are held overseas.
So
they levy a one-time tax and deem that money has been repatriated,
to bring it back, and
freeing it up so that it's no longer locked.
and what's
locked
that?
overseas.
What's that number? What's that percentage?
So right now, as of today, the numbers are 14 and 7. So 14% tax on liquid assets, so cash, and a 7% tax on money that's actually being reinvested abroad, so that has maybe been turned into a building or put into a factory. But that's subject to change,
So it's
I'm sure.
deemed, even though it's over there physically, it's deemed to be repatriated,
Yes,
and you pay 7%.
regardless of whether or not that money
to get
comes
a
back
good
or not.
housekeeping seal of approval that this is now in the territorial regime, not the worldwide regime.
Exactly, and it's not ideal policy. Like in the
Well,
in a perfect
it's a product
world,
of politics.
Yeah, in a perfect world, that money shouldn't have been taxed in the first place. But as a transition tax to get us to a better world, we can live with some rate.
How did we get into a worldwide tax
system?
system to begin with? Virtually every other country in the world has a territorial system. How did we end up with worldwide? Was it just because we were America and we thought we could get away with it, or what it was? Do you know the history there?
So as almost every other country used to have a worldwide system, just like most other countries used to have a corporate tax rate that was in the 35% rate like ours. But as the world has become more global, every other country has realized that the corporate tax is an outdated tax that isn't properly tailored for global economies.
Okay.
And that's as capital has become more mobile, as business supply chains have moved around the world, the corporate tax is become more and more inefficient, and a worldwide system becomes more and more detrimental to the economy. So as we've seen over time, almost every other developed country has moved away from a worldwide system and has systematically lowered their corporate tax rates. And the United States, having not reformed our tax code since the 80s, we just have been left behind.
You know, I wonder why they're not selling the bill based on that. I mean, we were really laggards in the world taxation system, and particularly when you think how the EU is so aggressive about taxing and things like that. But they're way ahead of us here in terms of taxing capital creators and innovators.
No, all the other countries are far more competitive, and we just kind of haven't jumped on that bandwagon yet. But I don't know if it's because people don't understand the international taxation. You start talking about a territorial system and worldwide, and that doesn't resonate with the average American. And it's, you're going to cut taxes for corporations by a significant amount.
Yeah, I had to do a little reading to know what that was before the show. Yeah, so most people don't know that.
Yes,
yeah,
exactly. And you try to put either of those words, territorial or worldwide, into your headline phrase of why we need tax reform, and nobody understands that.
And we want to stop inversions, and so it gets pretty.
And you see, and so when you describe the problem of capitals moving abroad or businesses are inverting, most people's reaction is, well, why don't we stop them? We need to put regulations in place.
That's what Jack Lew did.
Yeah, exactly. Yeah. Or we need to put a tax on businesses that try to move abroad to keep them here. And that's the opposite of the way we should be looking at the problem. The way that most other countries have approached this is becoming more competitive. How do we attract businesses here? It's not just about keeping businesses from leaving, but there's a whole world of businesses out there that could be doing business here, employing Americans, and that's really what this tax reform is about, is employing more Americans.
So with a territorial system with a 20% rate and being able to expense capital expenditures in year one and not have to, computers, great example. You buy a computer, what is it, depreciation a 3-year, 5-year, and within 6 months you got to buy another one because it's out of date. Yet you can't
You're
just
still
write
writing it off.
Yeah,
Yeah.
makes my accountant happy. He's got lots of schedules that he gets to bill me for. So this is pretty dramatic in terms of growth on the corporate side.
Yes. On the expensing, though, would note that this is an immediate expensing for most things, but it's 5 years. It's temporary, and that's due to revenue provisions and wanting to keep the bill within the limits in that time frame. And so, what depends going forward, is this going to have the full economic growth that full expensing permanently would have? Well, do the businesses really believe that it will be extended?
Explain why that's a problem.
So if you're a business and you, under a current code, at the end of 5 years, the equipment that you invest is no longer going to be able to be written off, then after 5 years, you stop investing. And so in the first 5 years, you get a huge boost in capital and productivity is increasing. But then you get to that 6th year, and now you're going to actually have a dearth in investment because everybody's already made their purchases and they're not going to, and then you start going down.
So we got a 5-year window. Businesses will invest a little bit year 1, 2, but by year 3, they're saying, look, this thing's going to run out. I'm going to go pile up equipment in the warehouse, so to speak. And then year 6, nobody's buying anything.
Exactly.
Okay.
And the provision that's in there only applies to new equipment, which is significantly narrower than it otherwise could be. The full expensing should not only be permanent, but should apply to all business expenditures, not just new equipment. So it currently exempts structures, it exempts used equipment, and that also leaves a lot of growth on the table. So although yes, this is a step in the right direction, I think the Tax Foundation estimated that this current plan would grow the economy by about 3.6% over 10 years. It'll be 3.6% larger than it otherwise would be at the end of 10 years. And that's about half the growth that we could have seen from a more robust business side reform of full expensing.
3.6 annual or 3.6
at the end of the 10 year.
So what does that work out per year, like 0.1% or something like that?
You grow over time, although that expensing kind of makes it level off there.
Yeah, I don't know what it turns into year over year, but it's less than the 1% increase that, say, the president has touted.
So what the thorny thing that got us into both the individual and the corporate at the same time is this pass-through. Let's dig into that a bit. I want to get to the individuals in a minute, but I think there are 27 million businesses that are taxed as pass-throughs, or 9 million businesses taxed as pass-throughs, and 27 million sole proprietorships, or there's some big number. It's like 30, 40 million businesses would be affected by this kind of change.
The majority of the businesses in the United States are these pass-throughs that file as individuals, and it's what they're doing is really complicated. So the bill puts a ceiling on the tax rate that pass-throughs pay of 25%, but then anything above that, they've added on some additional complicated rules that are really there because they haven't lowered the top wage rate, that 39% rate that we talked about. In the current universe that we live in, those rates are the same, and there's not a problem of businesses recharacterizing income into business income to game the system. And so, but because they've split these rates, they're now having to write complicated rules to prohibit gaming of the system, essentially. And so we're in this sort of second best world that requires these rules. They have a 70-30 rule on.
Taxpayers can elect to use alternative facts and circumstances. In general, 70% is treated as salary, 30% is passed through capital income. There's going to be a test looking at investment in the company, multiplying that by the sum of the federal short-term rate plus 7%.
Sounds like simplification to me.
Sounds like a mess to me. And then listen to the industries that are excluded. They're excluding health, law, engineering, architecture, accounting, actuarial science, performing arts, consulting, athletics, those are ball players, financial service, golfers can't be pass-throughs, brokerage services, or any trade or business where the principal assets of such a trade or business is the reputation or skill of one or more of its employees. I mean, this is open field for litigation and tax lawyers. I mean, they couldn't do better than this after thinking about this for years.
And so this is a product of not wanting to lower those top marginal
individual
rates.
rate.
So all of these things sort of fit together and put us into a place that is not ideal. They're trying to not lower taxes on the rich, but provide a tax cut to small businesses. And often these things are incompatible. You can't design a system that does all these things at once without these sort of complicated rules.
So to solve this mess, they could have just dropped the top rate and gone with the theory that history is maybe a predictor of the future. And in the past, when we dropped these rates, we increased revenue, and that would have gotten the pay for stuff done. Is that correct? If you believe that. But
yes, but
that brings up the scores, which is just this box that Congress is in. You have the
let's talk
distributional
about scores now. This is a good segue
and the
to
cost
scores.
Yeah, and so you don't get those revenue effects. We don't really have dynamic scoring. I mean, we might get some dynamic score called dynamic score coming out of the Joint Tax Committee, but they're not going to give the full, true growth effects that we believe are going to happen. And so you're tied into the Senate passed this $1.5 trillion maximum tax cut. That's all they can do. And so now you're just trying to get the revenue
To clarify,
necessary.
dynamic assumes that people respond to incentives and to rates. And people, if they're paying a 50% rate, will behave one way. If they get a 25% rate, they'll behave another way because they'll use that capital to do something. And that capital might go into innovation, investment, and growth. So you'd see more economic growth.
Exactly.
Static scoring is what we're using primarily, which says you can cut a tax and it has no effect at all.
Exactly.
or you can raise a tax and it has no
no
effect other than bringing in more revenue, which is not always the case.
70% tax will bring in twice as much as a 35 is what the static score will tell you. We all know that's not true because people aren't going to save as much, invest as much, et cetera, at a 70% rate as they will at a 35.
How can we cut this Gordian knot? I mean, is there anything, do we need some bold Speaker of the House to do it, or?
So a couple of the things that we pushed for and had hoped to see in these reforms is changing some of the budget rules that constrain the process. Currently they budget on a 10-year window, and then they're lowering that revenue estimate to 1.5 trillion. One of the things that we had hoped for is to see a longer 20-year window and allowing a lower revenue target beyond that 1.5 trillion to give Congress room to actually provide a tax cut to everyone, not have to get all these complicated rules to make that 1.5 number work. And then the economic growth would make it not nearly as deficit heavy as it otherwise would be. So it's working in the system, saying if JCT is going to give us this irresponsible score, we'll work within that world. But in reality, we understand that this isn't actually going to be a tax cut of $3 or $4 trillion. Mm-hmm. In the real world, economic growth is going to make up a big piece of this.
Yeah.
But that's not what we're seeing right now, and that's what sort of put us in the place that that we see Congress is making these horrible trade-offs to hit their revenue target.
Got it. We repeal the estate tax in this bill.
Mm-hmm.
But we wait until 2023. Mm-hmm. And so this is going to be, you can put a lot of investment dollars in the life support business.
Mm-hmm. Yeah, you do double the exemption immediately.
Keep Dad alive for another year.
Yeah, for some people, if they're not that close to death, then it's not a big deal. But yeah, this 5-year window we have going on.
What are they thinking?
This is the scores again. It's the revenue.
Because there's what the estate tax collects is like
it's
like 1% or less of the total tax.
0.7, yeah.
0.7. It doesn't. It's purely a political nod again to going after the wealthy.
and this revenue piece. Every dollar they're adding up in this process to get to that 1.5. So the delay allows them to have a little more expensing and have a slightly lower corporate tax rate, and each of these things that you turn the knob on a little bit, something else has to give.
Well, this is more like whack-a-mole.
Yeah, exactly.
I mean, 1.5 trillion over 10 years is really not that big at all. So we started with not that much to play with, and I think that's why we're seeing a lot of the policies that normally would not be even talked about in pro-growth tax reform. They would be given, of course, we're going to eliminate the estate tax. Of course, we're going to reduce the top marginal rate. But you've really gotten down to playing with single-digit billions of dollars per year. And so that's why I think we have these things you're talking about, phasing certain rates in, phasing other things out. And it's just come down to so much on the revenue side.
Well, let's talk about the politics briefly, because last time I checked, and I don't think this will be true for a very long time, the Republicans control the House, and the Republicans control the Senate. And the Republicans are for dynamic scoring. Is that universally true? Is that fairly?
Yes.
Okay. Yeah. Democrats don't. So if you control the House and the Senate, why can't you just say, we're not going to play this game, we're going to play by a different set of rules, we're going to play by dynamic, and we believe that this bill does what if we want a growth bill, we expect growth to come out of it, then let's eat our own cooking.
You are somewhat limited, though. You can't change those things necessarily within the time window that we have here for tax reform.
Is it statutory?
Yeah, I mean, the Senate has some control over which score they're going to choose to use, but it's not like they can call up the tax foundation and say, theirs is the most favorable score, we're going to pick that and use it. They're limited in that.
Well, they do that with polls.
But not when it comes to the legislative side.
Yeah.
And a lot of it is a lack of desire to make that bold move to say we no longer want to be constrained by these arcane rules. It's really they're allowing themselves to be shackled by process. I mean, you can debate whether or not that process came from a good place or has a role in the future, but it's a lot of the things they can change. It's just a matter of mustering the political will to change them. And the majority in the Senate is pretty slim. And so if you don't have everyone 100% on board, a lot of these things are just become more difficult than we would like them to be.
Well, you all wrote an excellent analysis of this last week. The GOP tax plan would revitalize the U.S. economy, which I highly recommend. It's on the Daily Signal website. It gets into the inside baseball of this and the sausage making. But one of the things that I found concerning is the headline is there's tax relief, and yet you look at what's happening with rates. There's the so-called bubble tax. There's a extra tax for people who make over $200,000, between $200,000 and $400,000. I mean, what is all this telling me?
I see you have little smiley faces and frowny faces.
This is a courtroom. This is a courtroom, and I'm handing the document to the defendants, and I've got very few smiley faces and lots of frowny faces here. Do you want to tackle that? Just explain a couple of those bullet points to me.
Yes. So as we talked about in the beginning, this is a rate cut, and it's also a net tax bill cut. At the end of the day, how much do you pay to the federal government for lower and middle income families? But once you shift up that income scale, the way that they've changed the brackets is such that a lot of income is now subject to a higher tax rate. What might have been 28 or 33% before is now going to be 35%. They've moved up the 39.6% rate, particularly for married couples. They did get rid of the marriage penalty that exists there. But on net, this group of people is generally not subject to any lower marginal rate. And for the most part, they're paying higher tax rates, in that window between about 200 to 750, say. And you're also getting rid of a lot of the exemptions, deductions that these people used to take. So for the most part, this is a general tax increase there, except for those that have the pass-through income. And then we'll get on to the bubble rate. So currently, the 39.6% rate is the top headline rate. We were hoping it would have been 35. They kept the current rate, so no tax cut, but actually a tax increase. So if you are a single individual, once you start making $1 million, and if you're a married couple, once you start making $1.2 million, they're going to recapture the benefit of having earned $45,000 or $90,000 at a 12% rate. They're effectively saying, we're taking this back from you. That's like scaling back $12,000 from individuals, $25,000 from married couples. How they do that is they put on a bubble rate and they add 6 percentage points. So you're at 45.6% now until you've recaptured that whole benefit of having the lower rate. So you have 39.6, 45.6, and then you go back down 39.6. So it's not simplifying things for this top rate. And
even and so the highest earners aren't going to be paying the highest rate.
Yes,
so there
and I'm
are
glad
people
you brought
stuck in
that
the
up
middle that
because
are going to be paying more than the highest earners.
This happened in 1986. They needed some more revenue, and so they did the exact same thing and created a 33% bracket. And then going forward, it was pointed out, well, this isn't fair. You have people making $5 million and they're not paying the top marginal tax rate. And so the solution should have been, okay, let's get rid of the bubble rate. Well, no, they raised the top rate to 33%. And so do we want to have a 45.6% rate going forward now?
Oh, my. Okay. Well, we were also in this bill, state and local deductions partially eliminated.
Mm-hmm. Mm-hmm. Yes. I've done a lot on the state and local side and analyzing the IRS data and who does this benefit. So it's a horrible policy to begin with. What are you doing by letting people deduct the taxes that they pay to their state and local governments? You're encouraging the state and local governments to raise taxes higher than they otherwise would. You know, California has a top marginal tax rate of 13.3%. But once you deduct that from your federal taxes, you're really only paying 8%. Mm-hmm. Who's paying that other 5.5% is every other American, you know, in the other 49 states. So it's a bad policy. Eliminating it is a great thing. But in the House side, you have some conservative members from New York and New Jersey in particular who said, we can't afford to get rid of this deduction. It hurts our constituents too much.
Well, the politics are interesting here. It's California,
Yes.
New York, New Jersey, Illinois, Massachusetts, Maryland, and Connecticut. Last time I checked, there were no Republican senators from any of those states.
And that's where it gets interesting is while on the House side they had to compromise and they said we're going to keep a property tax deduction in up to a cap of $10,000 per year. On the Senate side, you don't have any conservatives from those states. And so it's possible that maybe that's some new revenue that they can get in is by fully eliminating the state and local tax deduction and not keeping that property tax deduction that they have so far.
And then when it goes back to the House, it'll be a game of political chicken, theoretically.
Mm-hmm.
If the full SALT deduction is eliminated, the state and local tax deduction.
SALT, state and local tax,
yes,
okay.
Then those representatives that are from those high tax states will have to make a decision. Do they vote for comprehensive tax reform or do they not? And it'll hinge on this issue of the deduction. And I can't think of any Republican that would vote against the sort of tax reform that we're talking about on the basis of this piece, but there's
some of them did get out there and say, I will not vote for a bill that eliminates all the state and local taxes.
And so some Republicans are holding this tax reform hostage because they don't want the subsidy for expanding bureaucracies in New York, New Jersey, and California to go away, which on its face is pretty perverse.
We've got a couple minutes left. Where do you think this is going to end up?
So we have a House bill. It's being marked up, or it's being finished marked up right now. We should get a Senate bill next, which will be slightly different than the House bill, but not dramatically. The same process will happen in the Senate. They'll make some changes, and then the two bills will come together. I think from what we know thus far, we'll see a big change in the corporate tax rate down to 20%. We'll see some expensing. These are all the pro-growth things that are really good. We'll see some increase in the child tax credit. We'll see a doubling of standard deduction. We will see rates come down for most people. Hopefully, we'll see a little more relief for small businesses. And then the question is, how does it get paid for? So eliminating the state and local tax deduction, the repatriation tax we talked about, eliminating as many carve-outs and special privileges that are in the tax code. That's where sort of how we fund a lot of this. And so I think those broad contours will be there when it gets hopefully through the House and the Senate. It's just a matter of sort of what trade-offs they end up having to make along the way.
And they might have a little extra money to play with in there if we have the dynamic score from JCT by then, which should be hundreds of billions, maybe 2 to 4. We don't really know for sure, but there will be some money. So that's something that may provide something. The Senate side, certain members over there would like to see a higher child tax credit, even higher than the $1,600. There's some other provisions that would be in play, but I think we can also expect more complication. I don't think that the bill will get simpler moving forward. Timeline, I think they're aiming for Thanksgiving to kind of have a final package between the two, and certainly passage by the end of the year.
So it doesn't really simplify, it doesn't really cut the top rate, but it does a lot on the corporate side to promote growth. And so it's not perfect, but it's better than nothing.
Yeah, and I think I'm more optimistic than that because this is just the first iteration of it. We'll still see changes being made going forward. I think if we keep up pressure on needing to see a lower top marginal rate, that paired with a little more relief for those pass-through businesses, and then we have the expensing piece, at least temporarily, we have the lower corporate tax rate. This is setting us up to get a good piece of tax reform. It's just it's about keeping up the political momentum to really drive home these things that are necessary pieces of pro-growth tax reform.
Well, thanks, guys. Rachel, Adam, I look forward to talking with you more as this progresses, and hopefully we'll have another bite at the apple, maybe another tax bill next year. We can do some good then. So anyway, thanks, and we'll see you soon, and good show.
Thank you.
Thanks.
Thanks for having us on.
Thanks for listening. Want more? Be sure to subscribe to Common Ground with Bill Walton on iTunes.